On March 16th, a group of the most powerful people are going to come together and make a decision that is going to have a big impact on your life, your family's life, and pretty much everybody in the world. Who is that group? Can you guess? It's the Federal Reserve. To be more specific, the Federal Reserve Open Market Committee. These are the groups that come together. They're headed up by Powell, who's the chairman, and they determine whether or not the economy is running too hot or whether or not the economy needs a boost. And right now, what's on the table is whether or not they're going to increase their Federal Reserve rate guidance, which pretty much determines the overall price of money, the interest rates that banks might be charging or that you might get for a mortgage, for example. But this little mechanism here has a number of downstream effects on the entire economy and also has a number of downstream effects on the entire world because the US is such a dominant player in the global financial scene. So on March 16th, Powell and the Open Market Committee are going to have kind of a big decision to make, whether they raise interest rates or they lower interest rates. Now, for a while, we thought that they were going to maintain their overall easy policy that's been in place since the outbreak of COVID. Then a couple of months back, inflation started really popping up, and they started signaling that they were going to start raising interest rates. But then you had the Ukraine-Russia conflict break out, and now they're signaling that maybe it's not such a good time to raise interest rates. So I don't know what the right call is. I don't know what they're gonna go with, but what I do like to do is I'd like to see what markets think. I think that's kind of the best way to follow this type of analysis. And what I'll show you is a chart that I put together that tracks the overall probabilities that traders in the fixed income space or in the bond market are how they're betting in terms of what's going to happen with that particular meeting. So with that, let's jump into that visual and let's see how we put this together. All right, so this all starts with Jim Bianco of Bianco Research. First of all, I gotta say, if you're not following Jim, you got to follow Jim. He is one of the best investment voices out there. He's got great visuals, he's super independent, and he's often pretty correct. So I would highly recommend you follow Jim Bianco on Twitter and on LinkedIn. So Jim starts posting these charts about the what the market is expecting. This is from the CME group that trades futures based on bonds, for example. So they're going to anticipate what a bond might sell for in 3 months, 6 months, and then based on that you can back out the probability of what we think the Fed policy is going to be at that particular point in time, and it's priced into these bond prices here. So he posts a screenshot here and then also this graphic here, which is really interesting. It kind of shows you the overall transition of hikes over the last couple of months here. So what you're seeing here is you're seeing 1 bip here, so this is moving 1 bip, and this is sort of us thinking like, oh, we have to kind of start gradually getting out of this easy policy mode. And then here in February, early February, you see this big spike of probability that we're going to have 2 hikes. So this is really aggressive stance by the Fed. This is what the market thinks, and this is after a big inflation print, and everybody's like inflation, inflation, inflation. And then you have the market turmoil, and you have the Ukraine-Russia crisis here. And so now we're going back to thinking that it's just going to be 1 interest rate hike that happens on March 16th. So this is the March 16th. And again, this is coming from the CME group, the Chicago Mercantile Exchange that trades this sort of stuff. And I thought this was a really interesting chart. I liked it. I like it. But I thought it could be a little bit easier to read and a little bit more dynamic. So what I did is I got the data from the CME group, I crunched it up a little bit, I cleaned it up a little bit, and I repurposed it to create a dynamic, what we would call a racing bar chart, to help us visualize this a little bit more. Okay, so what you're seeing here is you're seeing the overall probability of interest of a particular interest rate hike. So you have 0 bips here, which means that there's going to be no hike in the Fed funds policy guidance. Here is 1 hike, here's 2 hikes, here's 3 hikes. And this is starting in March of 2021, so March of last year. And you'll see how, as of last year, last year, very accommodating. Still, COVID is the #1 concern, so let's keep policy in place. Now, this is marching through time. Now, you'll see that here, okay, we started thinking like, all right, is there an end to COVID? Do we need to start, or supply chain issues here? Do we need to start thinking about getting 1 hike in? And you'll see that kind of play out too. So that goes on, and no, not so much. This is still the dominant policy is that we're going to maintain easy policy, and going even into September, we think that. But then you'll see this change pretty dramatically starting in late last year. Boom. Okay, as of December, the market starts pricing in at least 1 hike, 32% probability, I should say. This is a 32% probability, 1 hike that's going to happen, 65% probability that we're gonna maintain that easy policy. So let's see how this changes as we go into bam. Okay, so as we go into the beginning of the year, we see that 1 hike is going to be what's going to happen. That's what the market sees. This is December late last year. Okay, so 53% of 53% probability at least of at least 1 hike. So let's keep going. Bam! Look at this. So everybody's confident. 80% probability at least 1 hike. This is January. Boom. Okay, more inflation concerns. So like now the market says absolutely not, they cannot stay on this easy policy. We for sure are going to get at least 1 hike, and a 25% probability of getting 2 hikes. Okay, this is February 7th. Okay, so then boom, oh my gosh. Okay, we got to rewind that back. Sorry to get a little bit too excited. Is it wrong to get this excited about Fed policy? Because it's a big deal. Someone has been in the markets, it's a big deal. This is like your Super Bowl. All right, so on February 15th, we felt the market saw a 50-50 chance of going 2 hikes up versus 1 hike up. So this is pretty aggressive stuff by the Fed. They're taking inflation seriously. So this is February 15th. This was a couple weeks ago, 4 weeks ago, right? So let's see what happens. And then boom, you go into late February. That's when markets start getting a little bit wonky. And then we go into this month, and let me rewind that back a little bit because I went a little bit fast. So we are at now, okay, so we went from mid-February thinking that it's 2 hikes, and now we are in late February, early March, saying like no, like markets are crazy. You've got Russia, Ukraine dominating the headlines, creating market turmoil. This is no, we're gonna for sure maintain. We're only gonna hike once now, not as aggressive. And if we continue moving forward, you actually start seeing some probability of us actually maintaining, not even hiking once. So that's been quite a bit of a ride. And this is the most recent data point that I have. This is March 2nd, so we are now on. That's 2 days ago. I think this has changed even since 2 days ago, but now the market says 1 hike. Pretty sure you're gonna get 1 hike, but even like no hikes is a possibility. And I gotta think that this is higher. This is as of 2 days. I gotta think this is higher. All right, I hope you enjoyed that visual. Let me know what you think, and a big thank you to Jim Bianco for being amazing on LinkedIn and being amazing on Twitter. You have to give him a follow. I'll be sure to include his details below. Also, if you want to learn how to put together that chart, I am pre-selling a micro course. Check out the link below, and I'll walk you through all the different steps that I took from getting the data from the CME, crunching it, cleaning it, and even into putting it into that dynamic chart that I showed you, all the different steps. You don't need to know any programming. This would be a very easy way for you to get some exposure to that. I think it'd be a good fit for an analyst that maybe is really good at Excel but wants to get into R and to get into some more fancy visuals. So check it out below, and I hope you enjoyed the video, and feel free to like, share, and subscribe. Thank you. Goodbye.